The importance of understanding the concept of inflation cannot be overstated for investors. It can significantly impact a bank's stock price and other financial institutions. When inflation rises, bank customers may want to withdraw their money and invest it in other investments that provide higher returns, which can ultimately harm bank stock prices. Hello, and welcome back to the Finance Guardian channel. In this video, we will examine the relationship between banking stocks and inflation, explain how investors can benefit from this correlation, uncover what banks would rather you not know, and more. So hit that subscribe button and the bell beside it, and let's get started. A lot of people think inflation makes everyone worse off, but it turns out that it's not all bad. In general, you're likely to benefit from unexpected inflation if you owe money and have to pay it back with a fixed interest rate. However, if someone owes you money, the money you are paid back won't be worth as much as the money you loaned out. What is the performance of bank stocks during periods of inflation? Bank stocks tend to underperform during times of high inflation because higher inflation rates lead to increased interest rates. As the rise in interest rates make it more difficult and expensive for banks to borrow and lend money to their customers, which lowers their profits. However, bank stocks can benefit from inflation in some cases. For example, if the bank has numerous loans on its balance sheet, it may actually benefit from higher interest rates since it will earn more interest income from those loans. Let us take the share price of the State Bank of India, or SBI, as an example. The SBI share price generally falls during times of high inflation, but it actually rose by around 9% in 2016 during a period in which the inflation rate in India was approximately 6%. A strong economy is also conducive to banks' performance. This is due to the fact that loan growth increases as the economy grows. People are more likely to take out loans when the economy is doing well, to purchase homes and cars, or to start businesses. This may result in increased profits for banks. So even though bank stocks typically underperform during periods of high inflation, there are some cases where they can actually gain. Why investors should pay attention to this correlation? There are several ways in which investors can take advantage of the correlation between inflation and banking stocks. To start with, investors may consider using the relationship between these two variables to determine when to invest. For example, if an investor anticipates that inflation will rise in the future, they might consider investing in bank stocks before inflation begins to rise. Second, this relationship can be used by investors to determine which bank stock to purchase. For instance, if an investor is seeking a bank stock that is likely to benefit from higher interest rates, they may wish to consider checking out the HDFC Bank share price. Last but not least, investors can use the correlation between inflation and banking stocks to hedge their portfolios. For example, if an investor is concerned about the impact of inflation on their portfolio, they may want to consider buying some bank stocks to offset the impact. Inflation's redistribution effect. Wealth is arbitrarily redirected from one group to another, such as from lenders to borrowers, as a result of unexpected inflation. Whenever people decide to borrow or lend money, they often take into account the rate of inflation. Likewise, the amount of interest repaid or earned will differ from what is anticipated when the inflation rate is different. As mentioned earlier, lenders suffer from unanticipated inflation because the money they receive in repayment has less purchasing power than the cash they lend. Meanwhile, borrowers benefit from unanticipated inflation since their repayments are worth less than what they borrowed. Deflation's redistribution effects. Unanticipated disinflation or deflation, which occurs when the inflation rate falls below expectations or even below zero, has the opposite effect of unanticipated inflation. Lenders benefit and borrowers suffer. Unanticipated disinflation or deflation benefits lenders since the money that is returned to them has greater purchasing power than the money they expected to receive when they granted the loan. On the other hand, it is particularly detrimental to borrowers when there is deflation because they must pay off their debts with money worth more than the money they borrowed in the first place. As a general rule, inflation policies are intended to maintain low and predictable inflation rates. Inflation that falls too close to zero can turn negative, leading to deflation. A recession and depression are often associated with deflation, which is extremely damaging to an economy. When policymakers talk about lowering inflation, they are referring to slowing down the rate of inflation or disinflation, not deflation. Common misperceptions. Most people think that inflation is bad for everyone. Well, who likes more expensive stuff? But that is not the case. Inflation lowers the value of money, so when people borrow money and the time comes to pay it back, they benefit from a higher inflation rate. Because of inflation, the interest rate that borrowers pay is effectively lower. Disinflation and deflation are also often misperceived as good for everyone. Who does not enjoy buying cheaper items, right? Deflation, however, increases the purchasing power of money. A borrower effectively pays back a loan with money that is worth more than the loan because of deflation. The interest rate a borrower pays increases. Inflation should always be avoided. Now that is another very common misconception. Deflation has such destructive effects on an economy that most policymakers agree that avoiding it is an even more important goal. Consequently, policymakers seek to maintain a low and predictable inflation rate rather than achieving zero inflation. Current savings account interest rates. Throughout 2022, the Federal Reserve issued 7 consecutive increases in the federal funds rate to combat inflation. The rate rose from 0.25% to 4.25% from March to December. However, banks were slow to raise interest rates on savings accounts. As a matter of fact, the national average rate of savings accounts sat at 0.10% or less through July, despite a rapidly rising federal fund rate. It was not until late December that the national savings rate reached 0.30%. A few credit unions and online banks offered savings rates closer to the federal funds rate in 2022, and some of the best high-yield savings accounts even topped 4% by the end of the year. How long will it take for rates to rise on savings? Savings rates are currently going up, and experts believe they will continue to rise in 2023. Online banks have begun regularly increasing their savings rates starting in April 2022. These challenger banks offer higher savings rates from 2018 due to lower overhead and a focus on increasing their market share. The interest rate on savings accounts is also increasing due to competition among banks. Banks are again advertising higher interest rates to attract customers and gain market share. And as long as the federal funds rate does not fall, rates will continue to rise. You are missing out on significant interest earnings if your bank is still only offering 0.01% APY on savings. Several banks offer savings accounts with interest rates greater than 3% APY. During the first year, you would only earn 0.25% in interest if you had $2,500 in savings at a national bank offering 0.01% APY. Compare that to an online account that pays 3%, you will earn 75% in interest earnings during the first year. What factors affect the interest rate on a savings account? Interest rates on savings accounts are heavily influenced by Federal Reserve policies. The Fed's monetary policies are designed to ensure strong economic growth and maintain steady inflation of around 2%. Savings rates tend to fall when the Federal Reserve lowers interest rates, but when the Federal Reserve raises interest rates, banks typically increase savings rates shortly after. A high-rate environment allows banks to lend for a higher profit, so they're more willing to incentivize savings. Banks and credit unions gain access to more money they can lend by offering higher savings interest rates. By following this strategy, banks also ensure they meet Federal Reserve requirements that promote appropriate liquidity. The interest rate on savings accounts can also be affected by competition between banks. New or smaller banks may offer higher interest rates to attract customers and grow their market share. How to get the best savings interest rate? You will get the best interest rates on your savings accounts by shopping around and comparing rates at different banks and credit unions. In addition, you may want to consider high-yield savings accounts, which offer above-average interest rates. Look for banks with no opening deposit or minimum balance requirements, and avoid savings accounts with monthly fees, which can eat into your interest earnings. If you want to increase your savings even faster, consider making regular contributions. Opening a new savings account is easy if your current bank doesn't offer competitive rates. And that is all the time that we have, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new, subscribe to our channel to remain updated about our future videos. We'll see you next time.